Let's start with the big picture on the economy. Obviously, the big story is tariffs. And we know that there's probably $100 billion worth of extra tariffs that are going to be paid in the next 12 months. We've started to see the beginning of that. That's about $8 billion or so extra of tariffs a month or so. And that number will fluctuate as Trump cuts his deals and adjusts the tariffs. But somebody is paying those tariffs. And the big question is, who is paying those tariffs? If it's the consumer, it should show up in consumer prices as higher inflation. If it's the exporter, it should show up in import prices. And if it's the company, it should show up in less margins. Well, here's what we know so far. It's not showing up in import prices because they have not really gone down a lot. Presumably they would cut the price so that you would add the tariff and then the consumer would get the same price or cushion it, but they haven't gone down meaningfully at all. We haven't seen anything in the earnings data, and I know we're early, to suggest that companies are getting squeezed on their margins. Stock market certainly isn't acting like it as the S&P continues to make new highs. And we might be seeing a little bit of it at the beginnings of it in consumer prices, but that's to be determined over the next few months. So what we're in kind of a funky situation where nobody's paying these tariffs, but somehow the government's getting an extra $100 billion in tariff prices. Now, I suspect that it's probably more of a data issue, that a lot of the import prices that we're seeing were pre-Liberation Day imports. They ordered them before Liberation Day, and those haven't got into the tariffs. Companies haven't yet really felt the full brunt of the tariffs in the second quarter earnings. And I think that consumer prices are still coming. So that's the big thing when it comes to the economy, is I think tariffs. Let me throw out a second big thing that's coming to the economy that I think is lesser understood by a lot of mainstream economists and especially labor economists. There's a lot of talk about payrolls, jobs slowing down and revisions coming that are going to lower those numbers. And it's naturally leading to people to scream, the labor market's in trouble, it's slowing down, the Fed's got to cut rates. And in fact, you heard Chris Waller make some of those points in his speech when he talked about the case for cutting rates in July, which he's going to dissent for a rate cut in July. But what's assumed in that, and has been assumed for decades, is how many jobs do we need to make to cover population growth and new entrants into the workforce, like recent college graduates and the like. And we just assume that that number is kind of a fixed number at around 75 or 100,000. But actually, the payroll report is a measure of population. And the population growth of the United States is collapsing right now. And why is it collapsing? We have a low fertility rate, especially post-COVID. We first had a big boom in immigration, and that was 90% of the population growth was immigration. Now the border's shut, and now we're deporting people, and we're trying to deport them in record numbers. That means that the population growth of the U.S. is going to go somewhere by the end of 26 into 27, somewhere around zero. Now, why is that important? Because for all of those that say, look, the jobs market has problems, we could see sub 50,000 jobs. There's an argument to make. The American Enterprise Institute did a study of this and said by the end of 26, we might only need to create 10,000 jobs a month in order to meet population growth if the border stays closed, deportations continue the way they are, and the low fertility rate. Well, obviously, that's not going to change because it's not going to be newborns, but it's going to be how many 16 and 17-year-olds and 18-year-olds are going to be rolling into the workforce. And I don't think a lot of people are realizing that. Yeah, the labor market is slowing. So what? We've got slower population. We don't need to create that many jobs to meet population growth. As a matter of fact, if we continue to churn out 75 or 100,000 jobs a month, and you might think that that's slow, that might be enough for a wage inflation push. So what I'm trying to argue here is on the labor side, we have two issues we have to look at. What is the jobs market doing? And what's the population doing? And where is that break-even rate that we need because of the population? So those are the two big things. Last thing I'll just say real quick, I still think we're at an economy that is still chugging along okay at around 2.5%. We had the distortion with tariff prices and massive imports being a drag on GDP that caused the negative first quarter. We're going to see a little bit of pop in the second quarter because that's going to end. And then we're going to settle out around 2%. And I still think we're going to settle out around sticky inflation being somewhere around 3% inflation. We're not on our way to 2 or sub 2 inflation like a lot of people think. And I think it's appropriate for the Fed to be on hold from here. At the initial stages of the tariffs that were announced right after Liberation Day in April, a lot of Japanese automakers, Honda, Toyota, and the like, cut their prices so that when those cars got imported to the United States, you'd slap the tariff on them, and you would see that the consumer would pay roughly the same amount for the car, but the hit was taken by the Japanese automaker. Okay, that was April and May. But starting in June and into July, Toyota, Subaru, and a bunch of these other automakers are already announcing that they're going to raise the prices. That was a temporary 1 or 2 month thing that was going on. But in general, if you are going to see international companies cutting their prices so that you could put the tariff on so the consumer pays the same price, you would see it in import prices falling, but they're not really falling. I mean, there's some examples and maybe around the margins there, but nothing to explain it in a big way. Otherwise, if you do want to argue, and I've jokingly said this to get my point across, if you do want to argue that no, international companies, the exporters in foreign countries, are going to absorb the majority of the tariffs, then let's just start chiseling Donald Trump into Mount Rushmore right now, because he found a way to tax very rich people so we could pay for Social Security, Medicare, and defense in the United States. Rich people in other countries is what he's wound up. Furthermore, he found a way to get the Chinese to pay for our defense so we could buy weapons to protect ourselves from the Chinese. Now, I'm trying to say that sarcastically to get my point across. Do I think that exporters are going to probably give a little bit on prices? Yeah, but a little bit. Do I think that margins are going to give a little bit on prices? Yes, I think they will, at least initially, like the automakers. But I think ultimately where all of this is going to land at higher prices for the consumer. And it's going to show up as higher inflation. And it may take a few more months for it to filter through, but I do think it's coming. There's definitely no doubt that that could be the case. In fact, you saw a little bit of that in the June CPI report too, that there was some instances where things like toys and furnishings and some apparel categories saw bigger than expected jumps. That was perceived to be that, where tariffs were, stuff that comes from China or imported overseas and they get slapped a tariff on them. But it was somewhat mitigated by falling airline tickets and owner's equivalent rent, and that somehow kind of offset it. I don't know how much of that we're really going to see at this point, because services inflation has typically been running around 2.5% to 3%. And then you've had goods inflation somewhere at around 0 to slightly negative for many years. And that's how you wind up with your kind of 2.5-ish to 3% inflation, a little bit, just below 0. But unless you're going to see something dramatic happen with services, you're probably going to see that goods category go up. Services could come down a little bit, but you'll see a bigger, push higher in the data. And let's remember too, the Fed likes to look at personal consumption expenditures, PCE. That category is probably going to rise faster than CPI because it has a smaller weighting in things like housing and in things like core services X energy, which is Powell's X Supercore. It has bigger weightings in goods stuff, in goods. And so if we're going to see a push in goods prices higher, that measure of inflation might rise a little bit faster than the CPI measure. Now, again, why does that matter? Because it's all about whether or not the Fed should be cutting rates. And in order for the Fed to be cutting rates, we have to see the inflation rate, continue to move lower. And I'm trying to argue that it's not going to, and I'm trying to argue that I think Powell, for all of the bashing that he's been getting, has had the right policy. In 1951, there was the Fed Treasury Accord, because prior to 1951, if you go back into the 1930s, the Treasury Secretary used to sit on the FOMC. The Treasury and the Fed were kind of one and the same. And then they finally split them out with an accord in 1951 saying that fiscal policy is the domain of the Treasury and the President. Monetary policy is the domain of the Federal Reserve. And the Federal Reserve has a dual mandate to lower the inflation rate and raise the employment as much as possible. Otherwise, if the argument is, no, we got to cut rates because we've got to try and save on interest costs, that's fiscal dominance. My reading in history is when fiscal dominance takes over on your monetary policy, there's a 100% chance it will end very badly. Now, that doesn't mean it's going to end very badly a month after they do it. It might be 15 or 20 years. It might be 1 year. But typically what happens is you're ignoring inflation. You're going to continue to force interest rates down because of, interest costs. When inflation comes, you won't raise them because that'll raise interest costs. That will exacerbate the situation in inflation, and it will just get worse and worse and worse. Now, like I said, that might be in 2 years or that might be in 15 years, but you've put yourself on a road for eventual disaster if you wind up doing it. The other misguided thinking is I've always kidded that, Trump is acting like Donnie from Queens, the real estate developer, because what he screams is, when he sent that handwritten note to Powell, look at all these countries with low interest rates and we're over here with high interest rates. We're the best credit. Our economy is hot. Everybody wants to be here. We should have the lowest interest rates in the world. That's the way a real estate developer thinks about things. I have the best building. My building's leased out. Everybody wants into my building. I can generate enough cash to pay my mortgage. I should have the lowest mortgage rate. In other words, what Trump is arguing is we are the best credit. And so we should have the lowest interest rate. There's one problem with that. Credit does not drive sovereign yields. All of them have the same credit. I'm talking about developed country. Is the US a better credit than the UK or France or Germany or Canada or Japan? At the margin, not really, because they all have printing presses and they all have the ability. If I own $1 million worth of treasury bonds and they come due, they have the ability to print up pieces of paper and hand me $1 million. Now, maybe they print those up and the value of those pieces of paper fall down and we have hyperinflation because they've printed paper to pay us back. That's a real concern, but it's not credit. So what drives sovereign yields? Nominal growth, expected inflation, and supply. Why is the U.S. at a 4.5% to 5% yield, which I think is the appropriate yield? Because we've got 2% growth. We got 2.5% or so. Inflation pushing, I think, towards 3%. So it's 4.5% to 5% nominal growth. We have inflation expectations, if you look at inflation swaps curves and stuff, trending higher, and we've got big supply. We should have 4.5% yields. Final thought, what do you do about all that interest cost? The answer is simple. That is Scott Bessent's problem. It is not Jay Powell's problem. And the way Scott Bessent needs to fix that is he needs to talk to the president about cutting spending. That's how you bring down your deficit. Otherwise, what you're trying to argue is we want more intrusive government. Right now, the federal government is 24% of US GDP. That is the highest it's been since we were spending money building tanks and planes to fight World War II. So that's an 80-year high, the amount of government we have in our GDP. What you're arguing about the high interest costs is we want more government. We want more bureaucrats. We want more rules, and that costs money. And we want lower interest rates so we could borrow even more money at those lower interest rates to give us more government. And the argument is, of course, the problem isn't the interest rate level, it's we have too much government. And we have to get rid of that government. And that's what Scott Bessent and the president should be talking about to lower interest costs, not demanding an artificially low interest rate from the Federal Reserve, assuming that would even work in the first place. Because I'm in the camp that if they did cut interest rates on the front end of the curve, it would be like, one of the other things Trump likes to say a lot is the Fed won't cut rates. Well, they did last year. They cut them 4 times last year. The 10-year yield was at 3.6. 3 months later, it was at 4.8. And the reason is that if you give us the wrong policy, the market rejects it. I think that when the market saw the Fed cutting rates last year, it said wrong policy. You're potentially going to create inflation. I don't want to own your bonds, sell bonds, and yields go up. And so what you risk by saying we should be at 1% is great. The funds rate's at 1%, and now we have the 10-year at 6.5. That's what you risk by doing something like that if the market does not agree and thinks it's the wrong policy.